Just imagine this for a second. A company raises almost 25 times more money from the public this year than it did just 3 years ago. Now, that's not some Silicon Valley unicorn we're talking about. It's the new reality for thousands of small and medium businesses right here in India. This is the incredible story of India's SME IPO boom. But the big question is this a rocket ship to riches or a bubble that's just about to pop? Let's dig in.
So this is really the core of what we need to figure out today. And if you're prepping for exams, getting your head around this is absolutely crucial. We're going to unpack the why behind this massive boom, the frenzy that's driving it, and of course, the new rules that are trying to keep it all from spiraling out of control.
Here's our game plan. We'll start with a journey of SME IPOs, how we got here. Then we'll decode this recent surge. We'll look at the anatomy of these IPOs, who's listing and who's investing. Then the big one. Are the gains real or fleeting? After that, we'll cover SEBI's new rulebook. And finally, we'll wrap it all up with the key takeaways for your exams. Okay, let's jump right in. To really understand what's happening today, we've got to go back in time a bit. It's a pretty fascinating story, actually, about how India's small businesses went from being in this sort of protected, sheltered environment to suddenly playing in the high-stakes world of the public stock market. Now, here's a term you absolutely need to know for your exams: the missing middle. For the longest time, India had this strange economic setup. We had tons of tiny micro-businesses and a good number of huge corporations, but there was this big gap right in the middle. The very policies designed to protect small companies were, ironically, stopping them from growing into medium-sized ones. So what was the solution? Well, it was about giving them a brand new way to get capital through the stock market. And this didn't just happen overnight. There were some early attempts, but they didn't really take off. The real game changer, that came in 2012. That's when the BSE and the NSE launched their own dedicated platforms. These weren't just new names. They came with simpler rules, lower barriers to entry, and they basically opened the floodgates for smaller companies to raise money from you and me. And, well, here's the result. Just look at this chart. This isn't a gentle climb. It's a rocket launch. We're going from a pretty quiet 244 crores during the pandemic to nearly 6,000 crores in fiscal year 2023-24. That is the explosion we're talking about, a truly mind-boggling increase in a ridiculously short amount of time. So the natural question is, what lit the fuse on this rocket? Let's get into our next section and really understand the 4 key drivers that have been fueling all of this incredible market activity. For easy recall, especially in your exams, just remember this simple mnemonic: RISE. It stands for robust retail demand, strong investor confidence, state government incentives, and the amazing ease of payment. These 4 things came together at the exact right moment to create what you could call a perfect storm. Let's just double-click on the I in RISE, investor confidence. A huge part of this was a flood of foreign money. In just 1 year, we saw over 2 lakh crore rupees pour into Indian stocks from foreign investors. Now, this didn't just lift the big players. It created this massive wave of optimism that lifted all boats, including the smaller SME market. And what about the E for ease of payment? This is where another key term, ASBA, comes into play. This system, especially now that it's powered by UPI, has made applying for IPOs just ridiculously simple. Your money stays right in your bank account, earning interest, until you're actually given shares. This has been a huge, huge catalyst for millions of new retail investors to jump into the market. Okay, so we know why the market's booming, but who are the actual players in this game? Let's take a closer look and dissect which companies are coming to the market, and maybe more importantly, who's buying up all these shares. Now, this is where it gets really interesting. You might think this whole IPO boom is about flashy tech startups, right? Well, the data tells a totally different story. The real engines here are traditional businesses. We're talking manufacturing and services. So this isn't just some tech fad. It's a story about the very core of the Indian economy finally getting access to public money. This chart tells you exactly who's driving the train. It's not the big professional money managers, the qualified institutional buyers, or QIBs. Look at their bar. It's pretty low and flat. They're kind of on the sidelines here. The real frenzy, the massive demand that's creating all this heat, is coming from everyday retail investors. They are the ones creating all the hype. And that brings us to what might be the most crucial question of all. Are these incredible gains you see on day one actually sustainable?
Or are retail investors who are chasing these quick profits, maybe unknowingly walking right into a trap? Let's look at what happens after the listing day party is over. So the key thing to get here is the difference in risk. Mainboard IPOs, they're relatively stable. Listing day gains are usually in the 10 to 40% range. SME IPOs, on the other hand, are like the Wild West. Yeah, the premiums can soar up to 400%, but that high reward comes with much lighter regulation and a far, far greater risk of big swings later on. There's this classic market quote that just perfectly captures the dilemma we're facing. The big question for everyone, investors, regulators, everyone, is where are we on this spectrum right now? Are we in a healthy, optimistic phase, or have we tipped over into dangerous euphoria where prices are totally disconnected from reality? And this chart tells a very powerful, very cautionary tale. For the most hyped up IPOs, the ones with the craziest retail demand, you see this massive pop on listing day. But then look what happens just 6 months later. The median return often flips into the negative. It's like the initial sugar rush just completely wears off, leaving a lot of the later investors with losses. So why the drop? Well, it often just comes down to the price. This table shows the PE ratio, which is just a simple way to see if a stock is cheap or expensive compared to its profits. And as you can see, just 1 week after listing, these SME stocks are trading at prices that are double, sometimes even triple their industry average. That is a massive red flag, that it's hype, not actual performance, that's setting the price. So, seeing all these clear signs of overheating and the huge risk to small investors, India's market regulator, SEBI, decided it was time to step in. They needed to bring some discipline back to this market. So let's look at the new framework they've put in place. SEBI's response can really be broken down into 4 main goals. First, make things more transparent so investors actually know what they're buying. Second, tighten the rules on how companies can use the money they raise. Third, crack down and prevent market manipulation. And fourth, which is really the goal behind everything else, protect the small retail investors. Okay, these are the new rules of the game approved in December 2024, and they're absolutely critical to know for your exams. Companies now have to show a track record of being profitable. Promoters face much stricter caps on selling their own shares. There are new limits on using IPO money for vague purposes, and a longer, phased lock-in period makes sure promoters have skin in the game for years, not just a few months. All right, we've covered a ton of ground, so let's pull everything we've discussed together into one final summary for your exam revision. This is the whole story, from the initial boom all the way to the new regulations. Okay, feel free to take a screenshot of this slide. Let's do a quick fire recap. Remember the key jargon, missing middle, ASBA. Remember the pivotal year, 2012. The surge in fiscal year 24 was over 5,971 crores, and the mnemonic for that is RISE. The market is driven by retail investors, not the big institutions. The biggest risk is that listing gains, lasting pains pattern, which points to overvaluation. And finally, the CV reforms from December 2024 are all about finding that tricky balance between letting the market grow and keeping investors safe. So this leaves us with a big lingering question. SEBI has put a whole new rulebook in place, and the goal is a healthier, more sustainable market. But will these new guardrails be enough to help India's small businesses find stable, long-term growth? Or will all that speculative frenzy just find new loopholes to exploit? I guess only time will tell.